Hey, welcome back to my Mastering Pro Forma Financial Projection for a Business Plan series. And what I'm going to be doing today is going over step 7, which is loan payments amortization, how to calculate them, where to include them into your profit and loss statement, as well as income statement. All right, so the way the video is going to play out is, first and foremost, going to go ahead and give you all a little bit of background about me, who I am, what I do, and why I do it. And then after that, we'll talk about loan payments and amortization, how to include them into your pro forma financial projection statements. All right, without further ado, let's go ahead and zip through this whole presentation. As promised, a little bit about me. Again, Paul Borosky, doctoral candidate, MBA, as well as owner of Quality Business Plan and Quality Business Consultant. I am a professional writer, specifically a business plan writer. So if y'all want to avoid all the fun and excitement, trials and tribulations, growth opportunities of writing your own business plan, feel free to pick up the phone, give me a call, send me a text, send me email. My contact information is right here. I would be delighted to write a business plan for you. I am also a published author on Amazon.com. Check out some of my books there. They're focused on business plan writing, as well as understanding financial statements. And then finally, I am an adjunct professor and subject matter expert in both business and finance. So if you do need some help with those pesky financial projections, business plans ready to go, but those numbers are keeping you up at night, I'd be delighted to do your financial projections for you. Again, pick up the phone, give me a call, send me a text, send me an email. Be delighted to help. And enough about me. Let's go ahead and talk about your loan payment, how to include it in your pro forma financial projections, specifically your profit and loss statement and your income statement. So you can use, again, any financial model you want, or you can go ahead and create your own or buy one. For this particular video, what I'm doing is I'm using my advanced financial model that I do have for sale on my website. But once you open up that model, or however you're going to calculate your loan payments, what I do for the loan payment information is in my model, or in your model, what you should have is you should have a section that's going to specifically identify what your loan is going to be for your business, whether it's a startup or an existing business. For this particular scenario, I'm saying that we're going to have a loan of $75,000. And once you go ahead and identify what your loan's going to be, in my financial model, what I do is I automatically have it generated down here in my loan information section. So whatever dollar amount you put right here in the loan information section, it'll automatically populate into your loan information section at the bottom. The next thing we want to do is we want to go ahead and calculate what the payment's going to be based on interest rate and based on term. In this particular scenario, we're saying that we're going to have a loan amount of $75,000, the interest rate 7%, and the term, or the length of the loan, is going to be 10 years. Once we put that information in here, I do use the payment function for Excel to calculate the payment. So based on this information, we've got a payment of $870.81. Now, for the pro forma income statement and the financial, for the pro forma income statement and the profit and loss for 12 months, we do not include the full payment into the into the calculations. For the financial statements, you're only going to include the interest portion that you're going to pay. So part of your payment, part of that $870 is going to be interest, and part of it's going to be principal. Well, the only thing that we're really caring about right now is the interest portion. That's the only portion that's going to include into your profit and loss statement. So in order to be able to calculate or figure out what your interest portion of that payment is going to be, you're going to need an amortization schedule. Now, for my financial model, I do include an amortization schedule that I created. Of course, there are going to be some limitations. For example, if it's like a 3-year term, well, this is going to break the model. But typically, most loans are going to be 5 years, 10 years, 20 years, and so on. So for the amortization schedule, if you want to go ahead and create your own, first thing you're going to want to do is you're going to want to start with your balance for the loan. Then you're going to want to go ahead and tie in your payment. The next thing you're going to want to do is you're going to want to figure out what your interest portion of each payment is going to be. And the way you're going to calculate that is you're going to go ahead and multiply the loan amount right here by your interest rate, which is 7% divided by 12, that you're just taking your interest and you divide it over at 12 months. It's not going to be precise to the penny as compared to what the banks are going to calculate, but it's going to be real close. Once you do that, you're going to go ahead and find out what your interest is going to be. You're then going to subtract that interest from your payment, and that's going to give you your principal. And then you're going to subtract your principal from your balance, and that's going to give you your new balance, which is what you're going to then base your interest rate on for the next month. Now, once you get this interest payment right here, this is going to then tie into your profit and loss for the first year. So if you'll see right here, my interest expense, this is where your interest payments are going to be. And you can see how it's going down. Year one is going to be $438. Year two, month one, $438. Month two, $435. Month three, interest expense was $432. So that's where you're going to tie in your interest expense, and then you'll subtract that from your EBIT, and then that's what gets taxed. So that's the whole point of that. For the income statement, all you're going to do is you're just going to add up your interest expenses from the first for your profit and loss statement, and you're going to plug it into your pro forma income statement. So that is how you're going to be able to, in summary, that's how you're going to be able to just take your loan payment, you're going to amortize it out, and then you're going to be able to properly include just the interest expense portion, which is what GAAP or GAAP allows us to do for pro forma financial projections. All right, so hopefully this information was helpful. Let's go ahead and wrap it up and sum it up now. Hopefully this information was helpful in mastering your pro forma financial projections. If you are interested in purchasing the template that I used in this video, you can just go to this link right here. And the template that I used was my advanced financial template version. And again, you can purchase it on this link. If you want a more basic template, I also offer a basic version of the template that I just used for this example. And you can, again, purchase that template right here for the financial model. If you don't want to mess around with templates and you just want somebody to do your financial projections for you, feel free to contact me. Check out my prices page. Love to write you a business plan, of a custom business plan. Love to do your financial projections for you. Completely up to you. Just let me know if I can be of service. And then finally, let's wrap it up with tutorials. If you want some more tutorials on better understanding or mastering your pro forma financial projections, just go to this link right here. All right, hopefully this information was helpful. Go out, make a little bit of money, and have a great day.